When people think about car insurance, they usually assume the price they pay is mostly based on things they cannot control. Many drivers believe their age, the type of car they drive, or the city they live in are the only factors that determine their insurance premium. While those factors definitely matter, insurance companies also pay close attention to driver behavior and financial habits. Small decisions that seem harmless can slowly increase the price of your insurance without you even noticing it. Over time, these mistakes can cost you hundreds or even thousands of dollars. The good news is that most of them are completely avoidable once you understand how insurance companies think. In this video, we will go through 5 common mistakes that increase your car insurance premium and explain how you can avoid them. Mistake number 1 is letting your insurance coverage lapse, even for a short period of time. Many drivers believe they can cancel their insurance for a few weeks or months and then simply buy a new policy later without any consequences. Unfortunately, insurance companies do not see it that way. When an insurer checks your driving and insurance history, they also check whether you had continuous coverage. A gap in coverage can make you look like a higher-risk customer. From the insurance company's perspective, a driver who goes without insurance may be more likely to drive uninsured or may be less responsible with financial obligations. Even if the gap happened because you sold your car or forgot to renew your policy, the system still records it as a lapse in coverage. When you apply for a new policy later, insurers may charge you a higher premium simply because of that gap. Some drivers see their insurance price increase dramatically after just one short lapse. The safest solution is to always maintain continuous coverage. If you are not using your car for a while, many companies offer reduced coverage or storage insurance that keeps your policy active at a lower cost. This way, your insurance history remains clean and you avoid higher premiums in the future. Mistake number 2 is choosing the wrong deductible without really thinking about it. A deductible is the amount of money you agree to pay out of pocket before your insurance company pays the rest of the repair costs after an accident. Many drivers automatically select the lowest deductible because it feels safer and more comfortable. While that sounds good at first, a lower deductible usually means a higher monthly premium. Over time, the difference can be significant. For example, increasing your deductible from $500 to $1,000 can sometimes reduce your premium by a noticeable percentage. If you multiply that monthly savings over several years, the total amount saved can be quite large. Of course, choosing a higher deductible means you need to be financially prepared in case an accident happens. That is why it is important to balance your deductible with your personal savings and financial stability. Drivers who never review their deductible often end up paying more than necessary for years. Taking a few minutes to evaluate your deductible could reduce your premium while still keeping you financially protected. Mistake number 3 is filing insurance claims for small or minor damage. Insurance is designed to protect drivers from large and unexpected financial losses. However, some drivers use their insurance for very small incidents like minor scratches, small dents, or inexpensive repairs. Every time you file a claim, it becomes part of your insurance history. Insurance companies track how frequently drivers make claims because it helps them predict future risk. Even if the claim amount was small, multiple claims can signal that you are a higher risk customer. As a result, your insurance premium may increase during your next renewal period. In some situations, the extra money you pay in higher premiums over the next few years can actually be more than the amount your insurance paid for the repair. This is why many experienced drivers choose to pay for small repairs out of pocket rather than filing a claim. By saving insurance claims for serious accidents or expensive damage, you keep your insurance record cleaner and reduce the chances of your premium increasing. Mistake number 4 is ignoring your credit profile and financial habits. In many countries and regions, insurance companies use something called a credit-based insurance score. This score is different from the credit score used by banks, but it is based on similar financial data. Insurance companies discovered through long-term research that drivers with stronger financial habits tend to file fewer claims. Because of this statistical connection, insurers often use credit information as one factor when calculating insurance premiums. Drivers with poor credit history may end up paying significantly higher insurance prices compared to drivers with strong credit profiles. Many people are surprised to learn that late payments, high credit card balances, and unpaid bills can affect the cost of their car insurance. Improving your financial habits can gradually improve your insurance score as well. Paying bills on time, keeping credit balances low, and avoiding excessive debt can slowly reduce the insurance risk rating that companies assign to you. Over time, this can lead to lower insurance premiums and better offers from insurers. Mistake number 5 is never comparing insurance companies or reviewing your policy. Many drivers stay with the same insurance provider for years simply because it feels easy and comfortable. While loyalty sometimes comes with small discounts, it does not always guarantee the best price. The insurance industry changes constantly. Companies adjust their pricing models, new competitors enter the market, and risk calculations evolve over time. Because of these changes, the company that offered you the best price 2 years ago might not be the cheapest option today. Drivers who never compare quotes from other insurers often end up paying more than necessary without realizing it. Checking quotes from multiple insurance companies once a year can reveal surprisingly large price differences. In some cases, drivers discover they can save a significant amount of money by switching providers. Even if you decide to stay with your current company, having other quotes gives you more negotiating power. Some insurers are willing to match competitor prices or offer additional discounts to keep you as a customer. Car insurance is one of those expenses that most drivers simply accept as a fixed monthly cost. However, the reality is that your premium is influenced by many small details about your behavior, financial habits, and insurance history. Small mistakes that seem insignificant today can slowly increase your insurance cost over the years. Understanding how insurance companies evaluate risk allows you to take control of your premium instead of just paying whatever price you're given. By avoiding coverage gaps, choosing a smart deductible, limiting unnecessary claims, maintaining responsible financial habits, and regularly comparing insurance providers, you can significantly reduce the amount you pay for car insurance. Instead of thinking about car insurance as something complicated or uncontrollable, think of it as something you can actively manage. The more informed you are about how insurers calculate risk, the easier it becomes to avoid costly mistakes and make sure you're not paying more for insurance than you really need to.